Hi, I'm Kara Murphy, and this is Money with Murphy. Let's talk about the impact that high oil prices have on what's been called the K-shaped economy. Shortly after the start of the conflict in Iran, we published a piece discussing the economic drag that higher oil prices create on the economy. When consumers have to pay more to fill their gas tanks, they have less money to spend on other items, which in turn slows the economy. But what's worth digging into a little bit more is how that drag is very asymmetric. Lower-end consumers are much harder hit by high oil prices than higher-end consumers. And that asymmetry has important political and market implications. First, what exactly is the K-shaped economy? On the one hand, affluent households and businesses are thriving thanks to rising incomes, higher stock values, and more financial flexibility. They make up the upper part of that K. On the other hand, a large section of middle and lower income families are living paycheck to paycheck. They're feeling the strain of higher prices. That's the lower part of the K. Importantly, energy shocks amplify these differences in experiences. So what's driving these seemingly contradictory forces? There are several fundamental forces at work. Higher income households tend to own more financial assets, and the robust 3-year bull market has seen widespread appreciation in the values of stocks, real estate, and other assets. These higher levels of wealth have driven that strong spending, at least among the wealthy. According to Moody's report last year, the top 10% of earners were responsible for as much as half of all spending in the economy. And that's the highest level for data that goes back to 1989. But at the other end of the spectrum, lower income households are spending a greater and greater portion of their income on necessities, things like food, housing, transportation. These households spend nearly a third of their income just on food. Meanwhile, food costs increased by nearly 25% from 2020 to 2024. The cost of electricity and insurance has also increased. And now higher oil prices are creating an additional drag. Some of this pressure can be seen in consumer sentiment. Survey data from the University of Michigan Consumer Sentiment Index has been trending lower and in fact reached its lowest levels in 3 years just in November. Interestingly, the wealthiest consumers report feeling much better about the economy than peers on the other end of the spectrum. But at the same time, many consumers are feeling the strain. The S&P 500 has posted 3 consecutive years of double-digit returns. So why the disconnect between frustrated consumers and higher stock prices? Simply put, corporate earnings continue to improve. Companies within the S&P 500 are expected to grow earnings anywhere from 12 to 17% in 2026 versus 2025. That's a remarkably strong pace. So what do investors need to know? High oil prices don't hit the economy evenly. In fact, they reinforce that K-shaped reality we're living in, where higher income households and corporate earnings can remain resilient even as a large portion of consumers feel increasing strain. And that divergence helps explain why consumer sentiment can be falling at the same time stock prices are rising. This dynamic means markets may continue to be driven by earnings and asset values rather than broad-based economic comfort. It also raises important political and policy risks as pressure builds on that lower half of the K. Understanding these crosscurrents and, of course, staying focused on fundamentals is critical as we navigate an environment shaped by higher energy prices and uneven economic outcomes. We'll continue to watch the situation and, as always, invest wisely and live richly.